Hello guys, how's it going today? I'm Atsu, and today I would like to talk about tax accounting in this video. So just to give you a quick background on myself, my name is Atsu and I'm working as an auditor for one of the big four accounting firms in Australia, and I'm also a US CPA. And I decided to make this video about tax accounting because I believe strongly, personally, tax accounting is one of the most complicated areas of accounting, and many have difficulty grasping the idea of tax accounting. So I thought it would be helpful if I could make a video to explain how tax accounting works. Okay, so I'm gonna go through a lot of slides, like 30 slides, very quickly, but I try to make my explanation clear and concise. Okay, so let's get started. So first of all, what is tax accounting, right? So why there is such thing as tax accounting? So the reason why we have what we call tax accounting is that there is a difference between the calculations of how much you have to pay to the tax office and how much should be recorded as tax expense in financial statements. Okay, so when preparing financial statements, you use accounting standards, right? For example, if you are living in the United States, you would use US GAAP. And if you're living in Australia, you would use Australian Accounting Standards Board, or AASB, which is pretty much in compliance with international financial reporting standards, which are used in a lot of countries in the world. Okay, but what I would like to emphasize here is financial statements are basically prepared using accounting standards, right? Whereas when you calculate how much tax that you have to pay to the tax office, you use different rules, which are tax legislation or tax laws in that country. So in Australia, we use Australian income tax legislation. In your country, it may be different if you are not living in Australia, but anyway, there is a different rule that governs the calculation of tax that will be on your tax return. Okay. So since we use different rules to calculate income tax expense in financial statements and tax on tax return, right, there is a difference between the amount calculated. Okay, and when people say income tax expense, it's composed of two things. Okay, so one is current tax expense, which is the amount that you actually have to pay to the tax office in the current year. And the other is deferred tax expense, which is a difference between how much you have to pay in the current year and how much you have to record in the financial statements. Okay, so the difference between these two calculations is a deferred tax expense. Okay. So what's the clear difference between these two different types of rules, right? So international financial reporting standards, or AASB or US GAAP, they all use accrual basis, right? Maybe you can recall what accrual basis is from the lecture that you were taking at uni or stuff like that. So accrual basis is a basis that you record things when it's incurred or earned regardless of the cash flow, right? Whereas Australian income tax legislation, or whatever the tax legislation is applied in your country, it's a cash basis. So, well, I cannot categorically say that it's cash basis, so that is why I said here it's like cash basis. So it's not exactly cash basis. It's very close to cash basis with some exceptions. And the reason why the tax office in your country or in Australia uses something that is very close to cash basis in calculating tax is that tax office cannot charge companies that do not have cash to pay tax, and the tax office doesn't allow companies that do not have cash, not to pay tax. So just to give you two quick examples to demonstrate them. So let's look at the first example here. ATO is Australian Tax Office, so you can replace this word with whatever the tax office is called in your country. Okay, so ATO or tax office cannot charge companies that do not have cash to pay tax. Okay, so for example, company A recorded unrealized foreign exchange gain of $100,000. Can tax office levy tax on it? Do you think you can? If the company is levied, if the company has to pay tax on the gain for which the company hasn't received the cash yet, it's very harsh, isn't it? It's very, very harsh, I reckon. So the answer is no, as a company doesn't have cash for it and will not be able to pay. Because this is unrealized foreign exchange gain, right? Even though it's recognized as gain in a financial statement, in fact, the company hasn't received anything that allows a company to pay cash to the tax office. So tax office understand that and doesn't really allow or doesn't charge tax on the unrealized gain. Okay, and let's look at the second example. So ATO doesn't allow companies that do have cash not to pay tax. For example, company A has recorded revenues of $200,000 and employee provision expense of $50,000. Okay, so this should be $50,000 by the way. Will ATO or tax office allow the company to pay tax only on the accounting profit of $150,000? No, because they will charge tax on $200,000 instead of $150,000 because the company hasn't paid anything for the provision and has the ability to pay tax on $200,000. So what I'm saying here is that, okay, so what this provision means is a liability that the company has to record for the annual leave that the company has to pay. Okay, so there is such thing as annual leave in Australia, which accrues over the service period of employees. Okay, and that is a liability for the company, and that's accrued over the period for which the employees have been working. But the liability is paid only the employee takes annual leave or actually leaves the company and receives it as cash payment. Okay, so that is an obligation from accounting perspective, and that's an expense from accounting perspective, so that's recorded as an expense in books or in financial statements. However, when you look at it from tax perspective, since there is no actual cash outgoings, right, it is not deducted. Okay, so when I say deducted, it is not recorded as an expense in tax return. So that's what I'm saying. Okay, so deduction is a word for expense and income is a word for revenue, by the way. Okay, so in tax they use a bit of different terminology, but they mean pretty much the same thing. Okay, so just to refresh your mind, current tax expense is a tax that the company have to pay to the tax office in the current year. And deferred tax expense is a difference between tax expense calculated based upon accounting profit before tax and current tax expense. Okay, so the difference is called deferred tax expense. And when you calculate this current tax expense and deferred tax expense, you take two different approaches. All right, so you take what we call P&L approach to calculate current tax, and you take balance sheet approach to calculate deferred tax. So P&L approach is literally an approach to look at P&L items to calculate it, and balance sheet approach looks at the movement in balance sheet items. So let's first have a look at how current tax expense is generally calculated. Okay, so as I said, there is a difference between the starting point of the calculations of income tax expense and actual tax you have to pay. So accounting profit versus tax of income. So there is a difference right here. So there is a difference in the starting points, right? in how you calculate the income tax, right? You need taxable income. But how can you calculate taxable income? You can calculate taxable income by making adjustments to profit before tax. Okay? So, what sort of adjustments do you have to make to profit before tax? So profit before tax is profit that is recorded in financial statements. Okay? So this is coming from your trial balance or financial statements. All right? And then you make certain adjustments to it, and then you get to the amount of taxable income. And then you just simply need to multiply the statutory tax rate in your country to calculate tax payable in the current year. Okay? So let's have a look at these two types of adjustments closely. Okay? So the first adjustment is called permanent difference, which is a combination of these two items. And the other is adjustment 2, which is called temporary difference. So what is permanent difference? Permanent difference comprises two items, as I said. Okay, so one is non-assessable income. So non-assessable income means revenues that are recognized for financial reporting purposes but never taxable. So for example, dividend income is not assessable, right? So it's not included in income tax calculation on tax return. Why? Because dividend income is coming from retained earnings, right? And retained earnings is after tax. So in order to avoid taxing the same thing again and again and again, ATO allows this dividend income not to be included in tax return. So this is non-assessable income. It makes sense, right? And the other one is non-deductible expense. So this is expenses that are recognized for financial reporting purposes but never deductible. For example, entertainment expenses. So entertainment expenses are costs like, for example, payments for bills, right? Of drinks that you have with a client, right? To maintain a client relationship and stuff like that. If entertainment expenses are deductible, what the company will do is that they will have a lot of drinks with a client and enjoy just drinking and, you know, having a combo and things like that, right? But it's not really reasonable for the company to be able to deduct all those expenses that they incurred in order to just have fun, right? So that is why the tax legislation doesn't allow the company to deduct entertainment expenses in tax calculation, whereas it is recorded as an expense from accounting perspective. Okay? So the next adjustment is temporary difference. Okay? So there is a reason for why this is called temporary difference. Temporary. Okay? So it's just temporary, transient. All right? So let's look at the first box here. So difference between accounting revenue and tax income, that's one component of it. For example, interest income. Okay? And let's look at the second box, difference between accounting expenses and tax deductions. For example, annual leave provision, depreciation, prepaid expenses, bad debt. So I kind of touched on this annual leave provision in a different slide, right? So what annual leave provision is, the liability that is recorded for the future liability that the company has to pay, right? When annual leave is taken by an employee or when, for instance, an employee leaves the company has to pay the annual leave amount in cash to the employee, so the company has to record liability. However, as I mentioned earlier, the company has to use something like cash basis, right, for tax purposes, whereas a company has to use accounting standards to prepare financial statements. So there is a difference in the timing of the record of annual leave provision or expense. Okay, So when you record annual leave provision in books, right, you record an expense. So that reduces your profit. But that is only deductible when paid, right, according to tax legislation. So that becomes deduction when employee actually takes annual leave or when the employee actually leaves the company and receives the cash, i.e. the company has to pay the cash. Okay, so there is a timing difference in terms of when the company can actually reduce their profit, right, between tax and accounting. However, this temporary difference unwinds, right, because it's just temporary. It's just a timing difference. So eventually this difference goes away, right? So that is why this is called temporary difference. Prepaid expense as well, okay? So when the company pays a prepaid expense or like rent, for example, expenses in advance, the company records prepaid expense, which is an asset in financial statement. However, right, from tax perspective, since it's been already paid, it's deductible. It can be deducted from your or in your tax calculation. Okay, so there is a timing difference again because prepaid expenses are expended or expensed over the period over which the services are actually performed, right? So for example, rent. If the rent expenses are incurred over 3 years, then the prepaid expenses are amortized over the 3-year period, right? So eventually, they are all deductible or expensed. However, there is a difference in terms of timing. So that is why it gives rise to temporary difference. Okay, it's temporary, so it will unwind eventually. All right. So this is actually bolstering the explanation that I have just provided. So looking at these temporary differences, so these are the things that you have to do in order to adjust accounting profit to taxable income, right? So for example, provision that I have just touched on, you have to add the expense back to the accounted profit because that will be deductible in the future. So you have to add it back, right, in order to calculate taxable income from accounted profit, right? And the next one, for example, gain on fair value adjustment or unrealized foreign exchange gain, these will be accessible, right? These will be accessible only when these are realized, right? So fair value adjustment or unrealized forex gain, well, they are recognized as gains in financial statements, but from tax perspective, they are subjected, they attract tax only when they are realized, meaning that only when the company has received the cash for those gains. Okay, so that is why you have to subtract it from accounting profit. And I'm pretty much explaining the same thing, like different types of things from the same perspective. So if you could have a look at these two as well and get your head around that, would be great, right? Like prepaid expenses, for example, deductible expenses for tax, yes, because it's been paid, but now your expenses for accounting, so you have to subtract it from accounting profit, in which this expense hasn't been expensed. Okay, all right. And actually, the movements, like these movements or these adjustments, can be explained by movements in temporary difference between accounting and tax bases, which is called balance sheet approach again. But I explained that in more detail later. And when you record current tax expense, journal entry is very simple. Current tax expense 30,000, current tax payable 30,000 in this case. All right, easy. And under over provision. So this one is very good to know. So as current tax calculation is a company's estimate of tax liability. So actually this calculation not necessarily will match the tax return that is lodged to the tax office, because tax tax period may be, for example, different from accounting period, and there may be some things that the company hasn't finalized yet when the financial statements are issued. So this is still the company's estimate of tax liability. All right, so this is not a finalized figure. And the actual payment of tax can be less or more than the estimated tax amount because it's an estimate, right? So the actual might be different from the estimate. So this gives rise to the possibility of under or over provision. Okay, so the under or over provision is determinable only after the actual payment is made, right? Because only when the payment is made, we can become certain as to how much we actually owed to ATO or to the tax office, which is normally after the issuance of financial statements. Therefore, prior year's under or over provision is adjusted in the current year's provision because we can't go back and adjust. So we make an adjustment. We put through an adjustment in the current year. So this adjustment is called true up. All right. So let me provide two examples to you to clarify on this. So one example is under provisions case, where the company's recorded tax provision of 30,000 in the prior year. However, the actual payment of 45,000 was made in the current year, meaning that the company should have recorded more, right, than 30,000. So it should have actually recorded 45,000, but in fact the company only recorded 30,000. So in the prior year, what the company recorded was debit current tax expense and credit income tax payable of this amount, 30,000. But in the current year, in order to adjust, before making a payment, in order to adjust this income tax payable, it records income tax payable of 15,000 and debit current tax expense of 15,000. In other words, right, in the current year, current tax expense is overstated by this amount, right? Unfortunately, it's overstated. But whether this has a material impact on the financial statements actually depends upon the materiality for the company that is determined by auditors. All right. Let me give you the second example, where the company recorded tax provision of 30,000 in the prior year. However, the actual payment of $10,000 was made in the current year. So it overstated tax provision by 20,000. Correct. So in the prior year, what the company did was debit current tax expense 30,000 and credit income tax payable 30,000. It's the same, right? But in the current year, since we know that the actual liability was 10,000, it has to make an adjustment by debiting income tax payable 20,000 and crediting current tax expense 20K. Okay. In this case, it's understating current tax expense by 20,000 because of this. Okay. The next one is deferred tax. As I mentioned earlier, deferred tax is calculated taking a different approach, which is called the balance sheet approach. So in the balance sheet approach, what you normally do is compare carrying amount, which is the balances, which is the balances recorded in the balance sheet in the financial statements, and then compare it against tax basis. Okay. So I need to kind of define what really tax base is, right? So the tax base of an asset or liability is the amount attributed to that asset or liability for tax purposes. This is not useful at all, right? This doesn't really make sense. So this is as per WSB 112 or as per IAS 1.2, but this definition is pretty weak. So if I would have to rephrase that, I would say this represents the amount an asset or liability would be recorded as if the balance sheet was prepared applying tax rules. So think it this way, right? You prepare financial statements based upon accounting standards, but at the same time, you are preparing a balance sheet using tax rules. So you have two separate balance sheets prepared using different standards or rules. And that gives rise to the difference in the balances recorded in those two types of balance sheets. So for example, as I said, prepayments. There is an asset recorded for prepayments from accounting perspective. But from tax perspective, there isn't such thing as prepayments, right? Because prepayments are deductions when paid, so there is no asset for it. So that is why there is a difference between the two. So like this, you compare accounting basis and tax basis and see if there is a difference, which is considered temporary difference. Okay, and the next step that you have to take is multiply 30% over these temporary differences to calculate deferred tax assets and deferred tax liability. So what deferred tax assets and liabilities mean is, so for example, let's use the same example, the prepayment, right? When you actually prepaid $7 million, that's a huge amount, but let's assume that the company made a prepayment of $7 million, all right? When you actually pay that amount, right, you can also see that the company paid a lot earlier than it should, right? So it made a lot of payment in advance, meaning that in the future, right, there will be more income that will be taxed. Does it make sense? So you deducted a lot in the current year by considering this $7 million as a deduction, meaning that in the future you won't be able to deduct for this prepayment, and thus there will be higher taxable income, which will result in higher tax that you have to pay in the future, meaning that that is your liability, that is your obligation. So that is why you have to record deferred tax liability. Does it make sense? Can I get the gist of it? Okay, so the next thing, maybe let's look at the provision for annual leave, because I've given you a couple of examples already. I think it can be more easily understood than the other temporary differences. So let me talk about this one. All right, so let's say provision for annual leave was $11 million. Okay, so from accounting perspective, you record it as an expense, but from tax perspective, not yet have you recorded it. So in the future, you will deduct it, right? So in the future, thanks to this provision, you can reduce the amount of tax that you have to pay. Does it make sense? Because that will be deducted in the future. So in other words, that times 30%, which is the tax portion of this provision amount, is future economic benefit from the company's perspective, meaning that the company should record an asset for it. Okay? So that way you calculate deferred tax assets and deferred tax liability. All right? So, I've explained that already. Let's look at another example in a bit more detail. All right, so in this example, property, plant, and equipment has been purchased for $900,000 on day one of the current year. The depreciation for accounting purposes is 9 years, and depreciation for tax purposes is 6 years. So, well, this is one of the also good examples of a case where there is a difference between accounting and tax. So in tax legislation, normally the useful life to be used when for depreciation is already set, whereas accounting standards do not really dictate how many years should be used in order to depreciate, right? So there is a difference normally between depreciation for accounting purposes and tax purposes. Okay, so looking at this property, plant, and equipment of $900,000, well, tax base and accounting base is the same because it's $900,000, right? And when you purchase it, it's recorded as an asset, so it's exactly the same. But the part that actually gives rise to the temporary difference is accumulated depreciation. So when you record accumulated depreciation, So it's a contra asset, so it's recorded like a liability on the right. Okay, so when you record accumulated depreciation, it's 150,000 because you simply divide 900 by 6, right? But from accounting perspective, since the useful life is 9 years, you divide it by 9, and so the company has to record the accumulated depreciation of 100,000. Okay, so that gives rise to the temporary difference. Temporary difference is a difference between accounting based and tax based, right? And this temporary difference gives rise to deferred tax liability. The reason why it's deferred tax liability is that, okay, you should consider this way. All right, so you recorded less depreciation than tax in the current year. Less depreciation, right? So you have to, or maybe in other words, you recorded more tax or more depreciation on your tax return. So you recorded a lot of deductions, right? More deductions than accounting depreciation on your tax return. Okay? Since you recorded more deductions in the current year, right, you will have less deductions in the future. Meaning that the taxable income, right, taxable income will be more, leading to more tax you have to pay to the tax office. Does it make sense? Right? You recorded more deductions than accounting, meaning that you will have less deduction in the future, and thus you will have to pay more tax in the future. And thus, that is your liability. Okay? And the journal entry you have to record is deferred tax expense, deferred tax liability. Okay? Easy. And in the following year, you do the same thing. Accumulated depreciation 300K, accounting on an accounting basis is 200K. There's a temporary difference of 100,000. Again, so in the current year, there is an additional 150, but from accounting perspective, there is an additional 100K. Still, the company recorded more deduction in the current year, meaning that there will be future liability. So you have to record deferred tax liability of $30,000. And in order to make sure that the company has deferred tax liability of $30,000, right? Since you already have 15,000 in your balance sheet, you just need to top it up by 15,000. So you credit deferred tax liability and deferred tax expense of 15,000. All right. So this is typically the part of tax accounting where confusion comes into play. Okay, so well, I personally often got confused when determining whether the temporary difference gives rise to deferred tax assets or deferred tax liability. At least I knew that would give rise to temporary difference, but I wasn't able to instantaneously tell whether that would be deferred tax assets or deferred tax liability. And I came up with this puzzle. Okay, so it's like a puzzle, right? Don't think it logically, it's like a puzzle, right? So what I'm saying here is there is an easy way to intuitively work out whether the temporary differences give rise to deferred tax assets or liability, okay? Which is to lay out tax and accounting balance sheet accounts in parallel, like below. So assets is sitting in the left and liability is sitting in the right. And you lay out tax books and accounting books like this. Tax, accounting. And you always have to place tax on the left, right? And the accounting on the right. And the way to memorize it is that you are talking about tax accounting. And when you read a sentence, when you read a sentence, you read from left to right, right? So you start from tax and then write accounting on the right, okay? So you lay out balance sheet accounts in parallel, like below, and recognize deferred tax balance in a way to reduce the gap. What the hell is it saying? Maybe you're thinking like that, right? So I explained that. In a way to reduce the gap. This is a key. So look at these crazy diagrams, all right? So let's start off with the top left one, okay? And the left side is an asset, right? And you lay out tax box and accounting box in this order. So looking at these tax bases, right? So this is a tax base. And this is an accounting base for this asset. There is a gap between these two bases, right? The gap is the width of these two dotted lines, yeah? And when you think about whether you should record deferred tax assets or liabilities, you always have to look at this accounting box, because deferred tax assets or liabilities are the balances recorded in accounting, right? Not on tax return, but in accounting. So look at this box, right? And what you have to think now is, how can I reduce this gap? Which should I record in order to reduce this gap? Gap is right here, right? So what do you think you have to record? Deferred tax asset. You need to record an asset in order to reduce the gap, because if you record liability here, the gap will increase, right? Because the net balance of this tax base will be smaller, meaning that the width will be larger, because this dotted line goes up a little bit. Doesn't make sense? A little bit confusing. It's like a puzzle, so you gradually get the grasp of it, I reckon. So let's go on to the bottom left one. All right. So in this case, it's the other way around. So from tax perspective, there is this amount of tax base, but on the balance sheet that was prepared using accounting standards, there is this balance. So the balance per balance sheet for accounting is larger, and there is a gap again. How can I reduce this gap? If you record an asset, the gap will be larger, so you can't record an asset here. So how can I reduce the gap? By recording deferred tax liability. So in this case, when an accounting base is larger than the tax base, when talking about assets, deferred tax liability is recorded. All right, so let's try this one too. So this is a case of liability. You have larger liability in tax than an accounting tax liability base. All right, so there is a gap of this amount. You always look at accounting box. How can I reduce the gap? By recording liability. If you record asset, the net liability will be smaller, meaning that the gap will be wider. That's not something that you are after. So what you have to record is deferred tax liability, because that's how you reduce the gap. Okay, and let's look at the bottom right one, right? So in this case, it's the other way around. So on the balance sheet of accounting, right? So there is a larger liability here. How can we reduce the gap? If we record the liability, there will be a further gap, which we don't want to have. So what we have to do is record an asset, which reduces the gap to here. Okay? It's like a puzzle, right? So if you go back to this diagram that we used a couple minutes ago, there is a difference between the two. You always look at this accounting box. How can we reduce the gap here? By recording deferred tax liability. It's quite intuitive, isn't it? So this is the magic I use. It's not really magic. It's a puzzle, or yeah, whatever you may want to call it. The tool that I use. Okay, so let's go on to the next example. So rent costs of $100,000 for the year 2, right? For the next year has been paid on day 1 of the current year. Okay, so for the next year, we paid $100,000. So that's prepaid expense from accounting perspective. But from tax perspective, since it's deducted when paid, nil. No such thing as prepaid expenses. So in this case, since there is a difference here, what do you have to record in order to reduce this gap? Yes, you have to record deferred tax liability, right? because if you record deferred tax asset, the temporary difference will be larger. So you just have to record liability. You have to just intuitively think, what can you do, right, to reduce the gap, right? So in this case, you just have to record deferred tax liability. It's very easy if you draw these diagrams. And what you have to record is deferred tax expense 30,000 and credit deferred tax liability 30,000. Okay. And in the following year, right, since it's incurred from accounting perspective as well, because this rent cost was for the second year, there is no difference between accounting and tax base. So you have to now reduce the deferred tax liability from 30,000 to nil, meaning that what it has to record in its books is debit deferred tax liability. So to reduce it, you have to reverse it, right? And then credit deferred tax expense, which is recorded as deferred tax benefit, right? Easy. I don't know why there's a K here. I have to get rid of it later. But anyway, all right. So the next slides, I'm talking about carry forward of unused tax losses. Okay. So, what is unused tax losses? So unused tax losses is this. So what is this, right? So in the previous example, this was taxable income. So this was positive, and thus the company had the liability to pay tax to the tax office, right? However, there is a case where the company records taxable loss when the company is not doing well, right? The company could possibly record loss from tax perspective. So in that case, that taxable loss times 30% is something that you can use in order to offset the future tax payments. Okay, so if you can use that to offset future tax payments, how would the company record it? The company would record it as an asset, right? Because that's, in a way, a future economic benefit. So it records deferred tax assets 225,000 and then credit deferred tax expense of 225,000. Does it make sense? Very good. And I'm not gonna talk about audit in this video. So that is all for today. I tried to explain everything in a clear manner, but if you have any questions, please leave your comments below. Try to answer those. There's no guarantee that I can, but if you could leave comments on this video, I'd really appreciate it. Okay, so thank you very much for watching this video, and hopefully this video was helpful in understanding tax accounting. Okay, so thank you. See you next time.